A tax credit is like a refund to you from the government. Now, at the beginning, we talked about adjustments and deductions, and a way to think about that, adjustments and deductions lower the amount of money that you pay taxes on. Okay, so for example, if I get so many dollars in my paycheck and I have to use some of that for business expenses, or I choose to give some of that away to charity, then they say, oh, we're not going to tax you on the money that you spent on those things. Okay, so they're just lowering the amount that you pay taxes on. Okay, and if I'm paying taxes in this 12% tax bracket and I lower my income, then it's 12% of whatever I'm lowering it by that I'm going to save on my taxes. Okay. With a tax credit, the credits are exactly their face value. They're applied after you compute your tax owed, and they're just subtracted off. That means that if the government gives you a $500 tax credit, that's worth $500, right? All of that money is just like money in your pocket, okay? And it's typically given as reducing the amount of tax that you have to pay by that amount. But there's actually two types of tax credits. There's what's called a refundable tax credit and a non-refundable tax credit. Okay. A non-refundable tax credit lowers the amount of tax you owe, but it's not allowed to go below zero. So if I look at this previous example, if this couple had $6,000 in non-refundable tax credits, then that just means that they would owe $0 for taxes, but it wouldn't go negative. However, if they had refundable tax credits, then you can actually lower your tax burden to below zero, and that means that the government pays you money for the year instead of you paying the government for the year. Okay. And some tax credits are a mixture of the two. So we're going to talk about a couple tax credits that are common ones to run into. Okay. So first, the child tax credit. And this one is fairly straightforward, except that nothing is straightforward with taxes, right? The child tax credit's a credit of $2,000 per dependent child. Okay, so when we say per dependent child, having a child biologically is not the same as having a tax-dependent child, right? So a tax-dependent child, there's an age restriction, right? Once they grow up, you can no longer claim them as a dependent child. There's also the restriction that we said before: a single person cannot be the dependent of two people's taxes. Okay, so for example, if you have two parents that file their taxes separately, they can't both claim the same child. Or another way to look at that is, if you're just starting college, you're working a job now, either you can claim yourself or your parents can claim you, but not both. Okay, so if you claim yourself on your taxes, then your parents can't claim you. However, you're not your own child, so you won't get a child tax credit for yourself. Okay. So this is a credit of $2,000. $1,400 of that is a refundable tax credit. Okay. So it can lower my taxes by $2,000, but if I have one child, I can only go negative by $1,400. And we'll look at an example of that. Okay, here's another tax credit, the earned income credit. So the earned income credit, I think generally speaking, is a tax credit for low-income people and families when they're filing taxes. Okay. Now, what I have here in this chart isn't how much you get for the credit. What we have in this chart is, based on how many children you have and your filing status, this is the maximum amount of money that you can make and still get an earned income credit. Okay, so if you have 0 children and you're filing as either single or head of household or widowed, then you can make up to $15,800 on your adjusted gross income. Okay, so it's the adjusted gross income that is the determining factor. If you're married, the threshold is a little bit higher, right? Married filing jointly, you can have a slightly higher threshold. Okay. If there are more children, then you can make more money and still get the credit. Now, something to keep in mind, if you have a married couple with 3 children that earns $56,844, they're not going to get the full value of the credit. Okay, the credit sort of scales back. The more money you make, the less credit you get, and once you hit this threshold, you don't get anything. Okay, all right. So we'll look at an example, but I think the easiest way to figure out how much you qualify for is just to use the IRS, website, right? They have this little app. You answer some questions, and you figure out how much your earned income credit is.